Good morning, everyone, and welcome to the Daily Trader with Kevin Hincks. Today I have two paper money trades on two high-profile names, Boeing, which is in the news today and currently up over $10, and then we'll look at Supermicro and its effects after yesterday's GTC conference and Jensen Huang's presentation, the keynote presentation at the GTC. So let's get right to our first trade of the day, and that is Boeing. Now, the news out this morning in Boeing, two actually news headlines: Japan Airlines ordering more 737-8 jets amid their global fleet expansion plans, and the CFO of Boeing, Brian West, speaking at the Bank of America Global Industrials Conference today. So at least one headline of a new order, and probably the comments he's making right now has Boeing up over $10, trading about 172. We're going to trade it right here based on these levels, and what we're going to look at here is just a relatively basic, but not basic, call diagonal, where we're going out to the April 11th expiration, buying the 170 call, just a couple dollars in the money, selling this week's March 21st 175 call, so a $5 call dial. But if you notice, it's a two-weeker, right? Which means you'll be able to actually, hold on, it is a three-weeker, 23 days till that April 11th expiration. What does that give you? It gives you the ability to extend duration on the short side and chip away at that net debit. Why? The net debit is a little pricey. For a $5 diagonal, it's over $5. It's $5.70, now trading $6.31 as the stock continues to rally. However, you do get that ability to chip away at the net debit by extending duration or taking the profits if it moves up towards $175. So whatever the debit paid, be it $5.70, be it $6.30, or something in the middle, that's the risk on the trade, and you're looking for a move this week towards the 175 strike. Diagonals are a way to give yourself a bigger delta while playing in the calendar space, where you're buying the longer dated, selling the shorter dated. It collects data, and this spread along about 24 deltas. Now, you could change the strikes and move your strikes to different levels based on your thought and expected movement in the underlying. But for this, the most important thing to learn here is the strategy, which is buying the longer dated, selling the shorter dated, using the embedded vertical spread for the diagonal. Okay, let's get to our second trade of the day, and that is Supermicro. Now, Supermicro, which is currently up 4%, up $1.70, that's also benefiting from new systems and rack solutions powered by the Blackwell Ultra platform. Remember, Jensen Huang introduced the Blackwell Ultra in the last couple of days at the GTC conference, so a more powerful version. SMCI possibly benefiting from that, introducing their new products. So, a very similar, buying the April 11th, selling the March 21st. In this case, buying the 38 call, which is just a little bit in the money, selling the 41 call. Now, again, the market's rallying. We did these a short while ago, and we paid $350. Now it's trading about $370 on this call diagonal. The expected move for the rest of the week is about $3. Now, could you make it $39.42? Can you change the strikes around? We do it all the time. That's the art in choosing some of these strikes. But you know the expected move is $3. Where you set the strikes is your personal choice. But the risk on the trade, the risk on any diagonal like this is the debit paid. Is it 3.5? Is it 370? Whatever you pay in the middle, that's the risk on the trade. And always in our call diagonals, you're looking for a move towards the short strike, in this case, $41. And remember, these are both risk-defined strategies, both buying April 11th, selling March 21st. Both will give you opportunities to extend duration, and both are risk-defined to the debit paid. All right, that's our show for today, everyone. I'll be back tomorrow with another edition of The Daily Trader. I'm Kevin Hincks.